Hi, and welcome back to the Business Career College video series. We're going to continue our series of discussions about the taxation of life insurance. And the next concept we're going to look at here is borrowing using life insurance. And there can be tax consequences to this. There don't necessarily have to be tax consequences to this. So there are two ways we're going to look at, two methods we're going to look at here. The first we're going to look at is the policy loan, which is the more traditional way of doing this. But we're also going to look at collateralizing a life insurance policy, or more accurately, collateralizing the cash value. We do also have to spend a few minutes looking at some business applications associated with borrowing using life insurance. So the policy loan, now let's assume here that, as we've seen in previous presentations, that we have a policy with the following characteristics. We'll give this policy a face value of $500,000. We'll give the policy a cash surrender value of $60,000. And we'll give it an ACB, and we haven't learned yet how to calculate ACB, but we will, of $25,000. Now you'll recall from discussions around capital gains that ACB is basically going to refer to the amount that can be borrowed without tax consequence. Or the amount that can be accessed without tax consequence. So what we're going to see here is that you could take a policy loan up to the ACB without tax consequence. Now, what we're normally going to see with policy loans is that, first off, there is no credit underwriting done here. That is, I don't care if you've got lousy credit or poor cash flow or you don't pay your bills on time, whatever the case is. The insurance company is the only party you have to deal with in a policy loan, and they have a very easy way to make sure that this loan gets repaid. If you don't repay it by the time you die, they'll just collect it then before paying your beneficiaries the death benefit. You can typically borrow between 50 and 90%, and this depends on contractual terms or administrative practices sometimes, but typically you're borrowing between 50 to 90% of the cash surrender value, and there is going to be interest payable on this loan. So you're borrowing money here, and some people say, well, that's my own money, I shouldn't have to pay interest on it. But the reality is you're borrowing that money from the policy reserve maintained by the insurance company, and they have to maintain a certain degree, a certain amount of returns in order to be able to pay the promised death benefits. So they are going to charge you interest because they don't have that money available to invest now. So the taxation here is pretty straightforward. You're just going to take the amount of the loan minus the ACB, and that gives us the taxable policy gain, exactly as we've seen in previous presentations. That taxable policy gain would just be added to your ordinary income. We would multiply that by your marginal tax rate, and that would describe the entire tax consequence to this transaction. So let's say, just for the sake of argument, that this person borrows $40,000 and they have a $25,000 ACB. This person would have, the policyholder would have a $15,000 taxable policy gain. Let's put them at the same 40% marginal tax rate that we've used elsewhere. That would give them $6,000 of tax payable, which is fairly straightforward. We can see if they borrowed something less than $25,000, there would be no tax to pay. Now, there's a little bit of an offset to this, and that is when this is repaid, when this $25,000 is repaid, it is deductible in that tax year for the policyholder. And then when you repay the $25,000, that is, you repay the $15,000 first, and then you repay the $25,000, and that's how this always works. You don't have a choice in this matter. The second thing that happens then is that you will then restore the ACB. So if you repaid $15,000 in 1 year, that first $15,000 would would give you a tax deduction, and then if you repaid the further $25,000 after that, that would restore your ACB. Now, something else that we do have to be aware of here, I said there would be interest on this loan, and the interest, and we've seen this elsewhere, if you borrow for business use or investment use, then that interest is deductible. So whatever interest you accrue here, whether it's paid or payable, that interest is deductible. And then, if you borrow for personal use, as with other types of borrowing, this is not deductible, but it does have the advantage of increasing the ACB. So your ACB does actually increase, which means your ability to borrow later on without tax consequence increases as well. Now, let's switch gears here, and we're going to look at collateralizing the cash surrender value. So what this means is that I'm going to borrow usually from a third party, that is another bank or some other type of lending institution, and I'm providing my CSV as collateral. This could be much the same, really, as providing your home as collateral on a loan or some other asset that would be valued in such a way that the institution could look at that and say, hey, we can actually use that as collateral. So we're going to provide the CSV as collateral here. All right, so this is actually a fairly common concept today. You'll see this discussed as insured retirement strategy or insured retirement concept, something like that. And basically, the way this works, if you can imagine, you've got your, let's just say universal life. This would work with whole life as well. And you've got this policy with this $60,000 cash surrender value. And now you're entering into retirement. So you're 65 or 70, whatever the case is, and you've got nearly enough income every year to meet your retirement objectives, but not quite. So you want to just boost that retirement income a little bit. So here's what you could do. You say, okay, lending institution, will you lend me this year, let's say $3,000? And you take that $3,000 as a loan, just like any other loan, and all you're doing is providing this $60,000 as collateral. And then next year you come back and do the same thing. So now you're borrowing this $3,000 every year from this lending institution. This $60,000 that's sitting in the bucket here, it goes untouched. So hopefully it continues to grow and you'll have more and more each year. Now, that being said, we do have to see what's happening with our loan over here, because this loan is going to attract interest. And there are two things that we can do with this interest. The financial institution, the lending institution, may allow us to capitalize it, which means you're not going to pay it every year. You're not going to service it every year. It means you're going to pay it at death. So you just let the whole amount accrue, and then at death, we're going to use the life insurance policy to pay that off, or you can service that debt every year and pay it off. So that, pay the interest off, I apologize. You can service that debt and pay the interest off every year, which means you would only have the lump sum amounts owing here. Those are two different ways to do this. Okay? And it just depends what you're trying to achieve. If you do capitalize the interest, that's going to ultimately reduce your estate, or if you service the interest every year, that's going to reduce your cash flow during retirement. It just depends which one is more appropriate for your particular set of objectives. Now, there's one more little bit that we have to look at here with respect to borrowing using life insurance. So I'm just going to slide the screen up here. And we're going to have a look at what happens when we borrow. We're not going to collateralize our life insurance strictly, but rather what happens here is I'm going to borrow for business or investment use. from an authorized lender, which would include a bank, an insurance company, or a trust company. So all the sort of normal lenders that we're familiar with. And the lender says, okay, I'm concerned. I know you're borrowing money from me, but I know it's very difficult to get a loan repaid when the borrower dies with that loan outstanding. So the lender says, you have to have life insurance. Often the lender will offer their own life insurance, their own insurance to support this, but you may have existing insurance in place. So they say you have to have life insurance. And if you have life insurance in place, they will allow you to undertake what's called a collateral assignment of the policy. We have discussed collateral assignment elsewhere. So I'm going to take a collateral assignment here, which means that the lender owns the death benefit before anybody else does. So that when the insurance company pays the death benefit, they're first going to pay that amount to the lender. The lender's going to take what they need to repay the loan and then pass the rest on to your proper beneficiaries. So this simply means the lender gets paid first. If there's no debt at the time of death, this doesn't mean anything. Then the lender just passes that amount on to the proper beneficiaries. But if there is a debt when our when our borrower dies, then we're going to have that debt paid off first, which will ultimately reduce the amount of the estate. Now, why do we talk about this in the taxation section? Well, what you can do here is you can deduct premiums. So this allows a deduction of your premiums. However, these conditions have to apply. That is, it has to be for business use, has to be for an authorized lender, and the authorized lender has to have set a condition that you have to have life insurance. And then this deduction is going to be limited. It's going to be limited to the lesser of either your net cost of pure insurance and your net cost of pure insurance is roughly equal to the cost of a basic term insurance policy, non-renewable, non-convertible, or the lesser of the premiums actually paid. And in all cases, whichever of those calculations you're using, it's going to be prorated, so that if you have a $1 million loan and a $2 million policy that you've collaterally assigned to this insurance company or to this lender, you would only be able to deduct half of whichever amount is in question here. That's a fairly complicated set of ideas, but it's all examinable on the life insurance exams as well as any financial planning exam you might come across. I hope this helps to understand the concepts around the taxation of loans associated with life insurance policies. Thank you very much.